Welcome to the Halftime Report. Thanks, Carl. I'm Scott Wapner. Welcome. Front and center this hour, the return of volatility. The Fed chair under unprecedented attack, and earnings season kicking off. We're trading all of it, of course, with the investment committee. Joining me for the hour today, Joe Terranova, Stephanie Link, Jim Leventhal, and Josh Brown. We will check the markets where we are down, at least on the Dow and the S&P. Nasdaq's gone positive. Russell is virtually flat. We know that stocks have been at record highs. So, Steph, investors are clearly bullish on the idea of the run-it-hot economy into the midterms, okay? BlackRock's Rick Rieder was with me yesterday on Closing Bell, and he revisited what he told me several months ago about how he sees the backdrop right now. Listen.
I'll never forget the interview we had. We said this is the greatest investment environment I've ever seen. I still hold to that.
You do?
Yes, I think it's a great, but I think what you're going to see now is much more volatility.
Okay, much more volatility, and maybe we're seeing some of that. Maybe some of it's self-induced by the Trump administration. The thing with Chair Powell obviously has made some people uneasy. What do you do in light of that and what could be a more volatile environment?
Well, it won't take much to see volatility increase. We just had 3 straight years of double-digit growth in the S&P, up 16% last year, 23% in 2024, and in 2023 we had 24%. So the expectations are high, the valuations are rich for the broader market overall, but the economy is gaining steam, clearly, at 5% in Atlanta Fed tracker. Consumers are doing their thing. They're consuming. AI, the momentum is still there. It's not going away. I do not believe 2026 will go away. I do think also you're seeing massive productivity gains. This is the big change for me, Scott. I mean, we haven't seen numbers like this in decades. I mean, we were growing productivity like 1-2%, 4.9% in the most recent quarter. Unit labor costs down 1.9. That is very, very healthy. And the productivity number is actually pretty good for inflation expectations. So add it all up, double-digit earnings. Going away from technology, though, that's where the expensive stocks are at. You clearly see the rotation happening, and I'm there, you know that, and I'm adding to them. We're going to talk about some of the things that I have been adding to, because I have conviction in the underlying strength of the economy. So volatility increases, use it to your advantage and buy on dips.
Josh, do you believe what Rick Rieder had to say again yesterday, that this is the greatest investing environment?
Greatest might be further than I would go, but Rick is very bright, and I wouldn't disagree with him materially on just the overall positive backdrop. You have deregulation with an occasional insane tweet. That's really powerful. It's hard to quantify, but people are taking risks, and people are going into new businesses, and there's tons of M&A that you actually can qualify. It's a great last 12 months for M&A. You've got IPOs back. We'll get SpaceX maybe by the end of this year. I don't know. Is that $1 trillion IPO? Maybe you'll even get OpenAI. Is that $500 billion, 3/4? I have no idea. Like, you can't look at a backdrop like this and say it's not a good environment. The real question is, are we already pricing in how good it is? And that's like the main debate. But look, I listened to the JP Morgan call this morning, and I know we're going to get there in a second. This is the CFO. Consumers and small businesses remain resilient, continue to monitor leading indicators for any signs of stress. Despite weak consumer sentiment, trends in our data are largely consistent with historical norms. We're not seeing deterioration. So people are not happy with the price of things. We all get that. That's what the midterms are going to be about in a few months. But at the end of the day, they're spending with abandon. Delta is making more money in the front of the cabin than the entirety of the main cabin of the plane. It's K-shaped, it's this, it's that. In the end, revenues are going up. Profit margins will be 14-15% this year for the S&P. Rates are either flat or maybe even lower. I don't know how you could argue with Rick materially that it's not a good backdrop to be making investments right now.
Jimmy, I'm glad Josh brought up the Delta information. It really is amazing when you look at it. The main cabin, okay, that's everything below first and business class, was down 7% year on year. Premium, which is first in business, was up 9%.
Yeah.
That screams K-shape. It represents what the greater economy has looked like. not commenting on the Delta number specifically here, but what about the backdrop? You do have this, I think it's fair to say, this self-induced volatility. Now, when you had this self-induced volatility of Liberation Day, that was short-lived because parts of the market got unsettled to the degree that the administration became unsettled looking at the market, becoming unsettled and the prospect of it getting even worse. Some are warning that the attack on Powell will backfire on those who want cuts. Obviously, there's the issue of what the bond market may do. Stifel says the S&P is going to consolidate around 7,000. Why? Because the, quote, emotional security blanket of rate cuts looks frayed. Schwab talks about today, buy to rate cuts. And then you have Wolf. We see several triggers on the horizon that could potentially spike bond volatility higher, including further worries about monetary policy and Fed independence. What do you think?
I don't think we need rate cuts. And I know there's a perception out there that the stock market is counting on rate cuts. I think that the market can fly without rate cuts because if we don't get them, it's for the right reasons. It's because the economy is growing. Stephanie, you just went through what the Atlanta Fed GDP is tracking, 5% for the fourth quarter, and in the third quarter it was 4%. We've got unemployment at 4.4%. And we got CPI today, which was really quite benign. I mean, I think the core was 2.7, maybe it was 2.6% year over year. I'm perfectly fine with that. Now, I'm not saying we won't get rate cuts because it's too early to determine that, but I really don't think we need it. We've got tremendous fiscal stimulus coming from the budget bill. And what if, as is presumed to be the case, the Supreme Court overturns tariffs? What if they mandate that the tariffs have been collected, have to be refunded, and another $200 billion comes flooding into the market? You know, Josh said, and I agree with him, that, you know, the good news may be priced into the markets, but there may be a absolute waterfall of money coming into the economy that will goose this market and this economy higher. I don't think we need rate cuts.
You didn't address, though, the issue of Powell. No, the issue of Powell and Fed independence.
Yep, let's hit it.
No, I don't. What do you think? I mean, is it a binary deal? The market's trying to look past it, not necessarily believing that it's going to go anywhere. However, if it's a Powell indicted market does something really bad, Powell not, then the market just blows it off. I mean, how do we think about it?
I think that the comments that were made yesterday by Ben Bernanke, Janet Yellen, Robert Rubin, and everybody else were right on the money, that in the long run, this does make us look like an emerging market economy. But I stressed just there, in the long run. This is a market right now that's focused on the short term of everything that I just said, profit growth, economic growth. In the long run, it is a very bad idea to bring the chairman of the Federal Reserve under investigation. Because what it does is it says to anybody else on the board, whether you're the chair or a governor or a Federal Reserve Bank, that if you don't toe the line, you are likely to be the subject of an investigation or fired, like Lisa Cook.
Yeah, the market is ignoring it.
What I just said.
For now.
What I just said.
Market's ignoring it for now.
The short term, the market is focused on economic growth, profit growth, low unemployment, stimulus, potentially tariff rebates. But in the long run, this will matter.
And he's not going to be around in the spring. He leaves. So why are we even debating it?
Because some are suggesting that he may not leave altogether.
Even if he doesn't
leave. And that could be an issue because then the administration wouldn't get the seat that they so covet to further, at least in their minds, guarantee
you're going to have a more dovish Fed. You're going to have a more dovish Fed. There's no question about it.
You don't care about this issue at all?
At all. Not at all. I just want them to get rates right.
Can't afford to.
We talked about this last time I was on Closing Bell. I mean, I just think they haven't gotten it right in so many years in terms of rate cuts or rate raises. I mean, so to me,
the Fed?
Yeah.
I don't understand. Like, what do you mean they haven't gotten it right in so many years? The whole reason why you are bullish in part on the picture right now is because you can make the argument that they may have gotten it wrong at the beginning, but they've certainly gotten it right since.
I think that
inflation's low and the economy's good. What more do you want?
And I think that they can cut because we don't have a housing cycle. We need housing to recover. And if you don't have a housing cycle, you don't have an auto cycle. And it's remarkable that we're growing 5% without those two big components. You need those two to actually recover. And lower rates is the only thing that's going to help that.
Joe.
Monetary policy is easy. It's getting easier around the world. To Rick's comment, as far as this being the greatest investment environment, from an asset allocation perspective, he's 100% right.
And they are the largest asset manager in the world.
And in 2025, we had a paradigm shift. You had the opportunity to invest in what was underappreciated and non-appealing type of assets, whether it was investing in developed international, emerging market debt, or back here in small caps. So that opportunity creates a much healthier environment. As it relates to volatility, there's different types of volatility. The volatility environment that's most challenging is when capital exits, because when capital exits the market due to volatility, it doesn't return. The volatility we're seeing so far year to date, which is warranted, is volatility that's suggesting we're seeing repositioning. You're just seeing capital being moved around in the market, trying to identify where the next trend is ultimately going to be.
You know where you don't want volatility to show up, where you've talked about before, and you know the answer to the questions I ask it. That's
bond market. And you have not seen that. The bond market remains calm.
To this point, you have not.
You have not seen it. And why is that a good thing? Because what the markets need most, what the economy needs most, is the cost of capital to be relatively cheap and getting cheaper, which we agree it is, and you need capital availability. And then to Steph's point, if you could fix housing and people are able to realize the perceived value of what their residential real estate might ultimately be, then that's going to inject even more confidence into the economy, more of a spending catalyst as well.
Because it's a multiplier effect, housing is. It's only 10% of GDP. But when you buy a home, you have to buy stuff inside the home. You buy stuff outside the home. You actually have to buy a car from the home to get to wherever you're going to be. That's why there's a real big correlation between housing and autos. It's very powerful. If we got that, we're going to grow even more. And that is a very healthy thing. And it also helps the consumer vacation.
Well, we are getting lower rates.
Yeah, 30-year mortgage.
It also helps the vacation. It helps the lower end if you have rates come down.
But they are coming down.
Well, but we're not seeing it develop in the housing market. Not yet. I'm hoping it does, because I have
housing's a big part of your trade.
But we haven't seen it. We need it.
You're likely to see it very soon. I know you've been patient, Stephanie. I know you've been patient. I think you're going to see it very soon. I mean, last week, the 30-year mortgage was below 6%. In the last year, it's been above 7%. That matters. Stephanie, you know, I'm not disagreeing with you, but we need more supply of homes, and that will come with lower interest rates, which you're seeing. And clearly, this president wants lower interest rates. By the way, that was one of the central planks of Secretary Bessent and President Trump's platform when they got inaugurated. Remember the 3 threes? One of them was to get the 10-year yield down to 3%.
Yeah, well, I mean, it's hard to do that when, in the other hand, you are holding up a big board of tariffs.
Scott, I agree. Totally agree.
Like they did.
I totally agree. However, let's point out that, and we were just saying this, that the 10-year Treasury at 4.18% is hardly nosebleed territory. And as the Fed continues to lower interest rates, which is the direction for now, whether we need it or not, think about all the interest rates that are tied to that, whether it's credit cards, whether it's auto loans. Help's on the way, and it's coming rather quickly, Stephanie.
Well, speaking of credit cards, did you guys see Visa and MasterCard again today?
Yeah.
They're getting hammered again today.
So you know what, Scott? All of this stuff, the credit cards, the companies can't buy homes, all that sort of stuff, reminds me of 6-7 years ago when we first got used to the Trump way of governing. And I remember when he blasted Boeing, rightfully so, for the delays on Air Force One, which still hasn't been delivered. I mean, we should all be used to this. And what happens in terms of being used to this is there is a couple of days, sometimes a week of response until the market wises up that it's easier said, literally, easier said than done to lower interest rates.
I would say, obviously, that makes perfect sense. I wonder if the variable in all of that, Josh, is the fact that the president and Elizabeth Warren spoke. And they're aligned on this issue, that what was believed to be just a throw-out comment, something with no teeth in it, because there's no law that would mandate these credit card companies, lowering their interest rates to 10%, could take on different steam if you have more alignment in Congress, which you don't have much on anything, but you may on this. I think that's why Visa and MasterCard are down again today. Trump and Warren don't speak. You're not seeing this move in the market today in these names. That's what I believe. What do you think?
Scott, I think you're 100% right. I think that conversation lends credibility to the people who actually think something will happen here. And maybe it does, and maybe the final version of it is so watered down so as to not even matter. We don't know. Back to the JPM call, they were asked to opine on this. They said, okay, If it's the most extreme version, obviously, that makes a material difference in the economics of this business. And then all of a sudden, you see a situation where banks get out of the sort of subprime credit card business that ends up being the lifeblood of a lot of consumers because risk just can't be priced appropriately. And I promise you, that's not going to be popular with Trump's base when people's credit card accounts start getting canceled or handed over. So, like, you could tweet anything. You could have a conversation with Elizabeth Warren about anything. But then what's step 2, 3, 4, 5? And the further down that road you go, you start to realize, okay, maybe this will help me with the midterms if the whole thing is going to be about affordability. And I know the GOP is spooked on that because it's one of the few things Democrats look better on in the eyes of the independent. But what are the second and third order effects of that level of disruption in the financial system? You know what? Let's forget it. I mean, does anyone on the desk remember 3 months ago, there was a tweet about carried interest with private equity firms? Like, those stocks went down 7%, and then the next day went right back, and we never spoke of it again. You know why? Because Elizabeth Warren is not the last phone call Trump's going to have. Then he's going to speak to Steve Schwarzman right after, right? He's going to hear from Bank of America. He's going to hear. So look, I'm in my 10th year of managing money in the age of Trump, both when he was in the White House and outside. And the main thing to do is not react to the first tweet.
No, but this may take on something different, which is why those stocks seem to be under added pressure again today. By the way, Microsoft, Joe, was upgraded today to a buy at Compass Point. Price target $735. That's on MA. Their top pick is Visa. The target goes to $436. So it was at $390. So they're still below where the stock is right now. You own MasterCard. Rick Reeder, in some of the commentary that he made to me yesterday, he's been a buyer of some of these names. He said it straight up yesterday on this set that he thought some of the move in the credit card names was overdone. Now, that was pre-knowing that the president and Elizabeth Warren had spoken. Whether that matters or not, I don't know. Yeah, what I do know is the stocks are down sharply again today.
They are, and I'm going to agree with Rick and Josh's remarks here. I think what you don't want to do here, there's a January 20th deadline, a deadline which, if we see the right conversations happening, we could extend the deadline. I think everyone agrees this issue needs to be addressed.
I mean, there's no deadline because there's nothing that would enforce anything at some deadline.
The president has put out their January 20th at a date.
There's no law that mandates that they have to do it by January 20th, no matter what.
Absolutely correct.
What is said?
I see that too. You're absolutely correct. But if before January 20th, we could have a conversation about what is a situation that needs to change, whether it's the educational capacity of understanding if you're a consumer, these are the behaviors that you need to have so you're not paying 20, 25, 30%. I think the deadline can ultimately be extended. And I think what I don't want to see for investors who have maintained position in a lot of these stocks for a very long period of time. I just look, Capital One is up 100% over the last 5 years, up 30% over the last 52 weeks. Synchrony Financial, that's been a good one too. So to Josh's point, if you react here and give up something that has been a winning trade for such an extended period of time because it's built on earnings growth, I think that's the wrong type of behavior.
Okay. Moving to tech, but not the mega caps, because I thought that Reeder made an interesting statement yesterday where he called out memory names. Now, you know the move that we've seen in the chips. We'll show you what chip stocks have done. The SMH is up almost 37% over 6 months. Look at Micron, for example. Look at that chart over the same time frame, okay? That stock has gone crazy, all right? Look at that. It's up 173% in just 6 months. Reeder, in saying that some of these stocks looked a little ridiculous now, was obviously talking about something like this. I mentioned that name specifically, to which he agreed. The price target goes to 400 today from 300. There's a lot of momentum behind this name. The trend is what it is. The chart tells a pretty good story. You own this name. Does what Reeder said make you at all think twice about taking a little bit off the table, thinking that some names within this universe especially in the memory space, have gone too crazy.
So the question really is, for me, if I had discretion, would I trim some here? Answer would be yes. If I had discretion, would I, and I didn't own it, would I buy it here? The answer would be no. I don't have discretion. We're rules-based. This is the purest representation of momentum that you're going to find in technology over the last 3 months. And it's a stock that was kind of late to the AI trade. The stock is extremely extended. It's nearly 20% above its 50-day moving average. So it is certainly vulnerable to a price correction. I will acknowledge that. We understand the fundamentals. At this point, if you don't know you have tight supply and really strong pricing, you're obviously living somewhere where you're not paying attention to any of the headlines.
The other comment he made, Jim, that was interesting, he called software this year, quote unquote, tricky.
It is tricky.
I said if it's tricky this year, what was it last year?
I mean,
last year was really bad. If you look at the IGV versus the SMH,
yeah.
Over the last 6 months, if you want to do that or whatever tells the story best, you will see exactly what I'm talking about.
It's been tricky. There have been spots, and I know you've mentioned this, Scott, things like Snowflake that has worked, but the bulk of it has been in the AI crosshairs as far as an industry that may potentially get disintermediated, and it's gone from mega cap. I mean, Microsoft's been kind of dull, to say the least, for quite some time, to the smaller companies like Adobe, which I own. I'll come out and tell you what I believe, which is that I think the fears of AI disintermediating software are overblown. I don't, and I remember, we've heard comments from others that 90% of software is going to be disintermediated. That seems a little bit too much for me.
Brad Gerstner made the comment
That's right, who said it.
He said 90% of the software stocks that are down a lot deserve to be down.
Yeah, that's what he said. Thank you very much. Now, look, I'm tired of getting to defend Adobe, but I'm going to do it again because this is a stock that to date, in the 4th year of the AI revolution, has not been disintermediated. The actual operational and financial results have been terrific, but the stock has sucked.
Okay.
Sucked.
Okay, hold on. I think that overstates it a little bit. You talk about terrific. I'm going to read you from the Oppenheimer note today.
Yep.
From the downgrade of Adobe, okay? In our view, Adobe has good medium-term opportunities and is a cheap stock. All right, they'll give you that.
Yeah.
However, they say, a challenging operating environment during the AI technology transition, leading to uninspiring and decelerating top-line growth, inconsistent execution with product cycles, durability concerns about their moat, lackluster investor interest for owning software names, and down year-over-year operating margin guidance in fiscal year 26 will likely weigh negatively on the sentiment. This doesn't sound like, oh, hey, everything's great. The market's just overdoing it on this name.
Well, what they've laid out there is exactly the arguments over the last, now in a 4th year of doing this, that's all coming. That the growth rate is going to slow down, and that the margins have gone down a little bit. I will admit that. However, this is a stock that is still projected to see 12% earnings per share growth over the last 3 years. I mean, the top line has grown at 12%. This is not dead in the water. It's trading at 13 times earnings. And I disagree with the note, because what the note is saying is what is yet to come. That there are all these hindrances yet to come. That's what the thesis has been to the bear side for the last 3 years. It just hasn't shown up.
Well, the note, what do you mean it hasn't shown up? The note matches the chart.
Yes, I'm saying operationally in terms of what has actually happened. Revenues have grown
Jim,
in the face of this threat.
If they were knocking it out of the park, I'm sorry, the chart wouldn't look that way.
Okay,
Let's be honest.
I am disagreeing with what the chart is saying. This is my prerogative as an investor. It's a prerogative of any investor. Any of us, we take positions. We look at what's happened in the stock and we say, I don't think that is right. You've heard me say this before. I'm going to say it again.
Right.
Sometimes the stock market gets it wrong, and I think it's getting it wrong on Adobe.
Let's finish with what is arguably, I'm not going to say it's the biggest story of the day in tech, but it's got to be up there. And this is according to the FT. And it was matched, by the way, by Microsoft's Brad Smith with our Eamon Javers within the last hour. That the likes of OpenAI, Google, and Anthropic face being outpaced by Chinese AI rivals in the race for global growth. That is what the president of Microsoft did tell the FT. Again, he sat down recently, last hour or so, with Eamon Javers because of DeepSeek. Now, are we Steph, do you think, underappreciating the threat, if you want to use that word, that DeepSeek remains in the global market share arms race that AI has presented? We all remember what happened more than a year ago when the market had a DeepSeek unsettled moment, right? And I'm being kind, okay? It took a DeepSeek.
We got you.
I think they can all coexist, Scott. And at any given time, one's going to be ahead and one is going to be.
This doesn't sound like this at any given time.
I'm not an expert on DeepSeek, but I can tell you that we bounced back pretty darn hard last February after we all panicked about learning about DeepSeek. It wasn't nearly as competitive as it turned out to be. Doesn't mean that they're going away, but it means that, to me, we have some amazing companies that are doing amazing things, and I would not want to put all of my eggs in one basket, especially DeepSeek.
Anybody else?
I think there's a real threat here from China. I don't think it means that the AI stocks in the U.S. or outside of China are doomed for failure at all. But I don't think we should dismiss this. There was an IPO last week of a Chinese AI company called Zhipu, which shows that they are not slowing down. This is a year after DeepSeek. What the threat is here is that China does what it's done with the internet and just create its own AI universe. And, let's not forget that there are 1.2 billion people in China. That's roughly 1/5 of the globe's population.
I disagree. I do. I think, I'm sorry, Jimmy, and if I'm cutting you off, I apologize. I think the technology is inferior at best.
Great.
When you look at these AI chips, there's so many concerns. The concerns about stacking. Well, they don't resolve that question, DeepSeek. NVIDIA gives you the ability to not have the stacking concern. Then we heard last week of the Rubin chip that resolves the issues surrounding data cooling challenges. The technology continues to advance more and more, and it's being advanced by our companies here.
I'm not selling NVIDIA, okay? Let me be clear. On the other hand, I am aware that China is absolutely not stopping in its pursuit to replace NVIDIA with homegrown chips, and I use that as one example. It's a threat that bears watching, is my point.
So let's squeeze a break in here. We're going to come back, and we're going to get to several moves from Stephanie Link. Joe has one as well to tell you about, but the Linkster's been busy, as usual, and we'll tell you where next. All right, let's do these moves. We continue to watch energy. Crude is at $60. That's the highest level since mid-November. Stephanie Link bought Chevron last Friday, and she bought more today. Tell us more.
I want to have more commodity exposure, not less, that's for sure. And Chevron is the best of the best. And it's trading right now at 11 times EBITDA. And in the past year, it's only up 9%. And they have diversified assets. They've got very strong free cash flow. The CAGR on free cash flow is expected to grow something like 10% between now and 2030. And I don't know what is going to happen, Scott, with Venezuela, but they obviously are a player. And I think on the margin, they will see an uptick once we get through all of this. So to me, it's best in class. And oh, by the way, I really do like the M&A that they have been doing, too, which is very synergistic. So I wanted to have more exposure to energy. I still think it's under-owned. I was under-owned all last year. I didn't own one. So now I own SLB, which I bought back in November, and I've been adding to it, and now Chevron.
If you're under-owned, we're big buyers of Stephanie Link, okay? We're long L-I-N-K shares, okay?
Yes, thank you.
Just to be clear.
Okay.
Okay, so you said that Chevron, they're players in Venezuela. Josh, Exxon is not, okay? Darren Woods made that abundantly clear what he thought about the investing opportunity at the White House last week, to which the president took issue with, quite obviously. We already know that by now. Exxon hit a record high today, though, surpassing its prior high from October. How do you view this name right now?
Yeah, this is a sector-wide phenomenon, and I bought Exxon just as kind of an exemplar of the space. These stocks were completely left out of the bull market over the last couple of years, and with good reason, but things are changing. 85% of the XLE names are above their 50-day. 19% of these stocks are making 52-week highs right now. And guys, as Farmer Jim has pointed out, that's with crude oil in the 50s. Can you imagine if there's any sort of uptick whatsoever? Hartnett was talking about the energy stocks being the contrarian call of the year. He actually made a comment in December. Soon, every commodity chart will look just like gold. If oil looks 10% this year as good as gold looked over the last year, not one of these stocks we are not bullish enough on any of these stocks. So I don't think Exxon will go up the most. I just think it's the safest. I'm bullish on a lot of names in this group: Halliburton, Schlumberger. We've talked about Baker Hughes a couple of times on best stocks in the market. I think you want to be in these stocks.
Yeah, Steph, you're in SLB. The target goes to 52 from 43. Ray J says outperformed yet again. Joe, you have a new buy.
I do.
It's a personal buy. It's the oil services ETF. It's the OIH, 52-week high today.
All right, so let's do the Josh Allen snow plow into the end zone here on why you should be buying energy. My ownership is Baker Hughes through the ETF. It is Valero. It is EQT. Everyone understands the geopolitical risks. Everyone understands what Steph and Josh has eloquently explained. When you actually go out and call around, you talk to people who are trading the energy markets, when you talk to people who are running non-discretionary capital trend following, and they allocate in the crude oil market, I can't find anyone that's long. Everyone is short.
That's totally
and when
true.
you look at the CTA, Commitment of Traders reports, it is represented there. So even a mild uptick above 60 to where we are right now, approaching $61, that's going to lead to a little bit of a short squeeze.
So, I mean, it's only 3% of the S&P 500 weighting. So for a long time, you could ignore it. You didn't have to pay attention to it. But that's where your real alpha generation is, if you can go find quality names. And I am barbelling it because Chevron is the safe way to play it. SLB is the beta. So I think you want to have a double weighting.
Just quick on ExxonMobil, biggest part of the XLE. Over the last 5 years, its beta has been almost 0.5, meaning it's had half the risk of the S&P 500. That's made it kind of boring, and Josh was alluding to that. However, over that 5 years, the annualized return has been more than double that of the S&P 500. That's the holy grail. Twice the return with half the risk.
Right,
that's the holy grail.
Let's get the head. Time for Josh Brown's best stocks in the market. Our spotlight is on a very nicely performing materials sector and 3 names within it. What do you got?
Yeah, so it was kind of cool to see these names pop up. Most of the materials exposure on the best stocks in the market list last year were the gold miners, which obviously we talked about Newmont, we talked about Anglo Gold Ashanti. They were incredible home runs. Now we're seeing something different. Cement, ready mixed concrete, aggregates, asphalt. You look at Martin Marietta. Let's put this chart up real quick. MLM. Very simply put, these stocks are not heavily owned. This is like one of the blue chips in the space. It's a $40 billion or so market cap. And I use that term blue chip somewhat tongue-in-cheek. But this one and Vulcan Materials, which is VMC, also $40 billion in market cap. Both charts look exactly the same. They look incredible. They are breaking out above those fall highs. Everything seems to be lining up. RSI not yet overbought. They really haven't been discovered yet. The other name worth, I would stay with those two. CRH is a chart that's sort of already made a big move. I just want to put it on people's radar because it may consolidate for a bit. You look at that 50-day moving average serving as support. If you want to take it for a trade, that's maybe where I would stop out.
Well,
but I think the other two are a better setup.
CRH got downgraded today. Maybe to your point, the analyst at Wells is sort of thinking about the same thing. Equal weight from overweight. So, you know, the stocks had a nice move
Stocks
as you see.
already. Yeah.
So maybe that plays into that. Jimmy, you own that name. What do you think about this spotlight today?
This is a stellar long-term holding. You know, if the downgrade today is because it's run up, that's fine, you know. But I think for those of you who want exposure in this space, this is actually the name to own, and I'll tell you why. Vulcan and Martin Marietta, great companies. They traded a 30 times forward multiple. CRH is 20. Now, here's where it gets more interesting. The market cap of CRH is twice that of each of Vulcan and Martin Marietta. This is an industry where scale matters. You're talking about distributing really heavy material, concrete, aggregates, all that sort of stuff. Spreading your fixed costs over a bigger company matters. CRH to me is the long-term holding. Will it be up and down over the short term? Sure, but the long-term track record, not going to go through the numbers. You can look it up. 1, 3, 5, 10 years, it's crushed the S&P 500.
Can I ask a question? You own gold?
I own Newmont. We bought Newmont in April at 52 in the ETF. I owned the GLD, got out of it recently.
Why'd you get out of it?
Because I made a mistake.
Okay, that's where I was trying to probe. You own gold?
I do not own gold.
I'm trying to understand why everybody doesn't own what has been one of the best and seemingly.
I prefer copper.
I hate to use the word easiest because nothing to what you guys do is that simple, but man, that trade seems like the writing's been on the wall.
Silver's
and in
the trade.
many respects, it still is.
Silver is the trade right now because silver actually has more fundamental validity in its ownership than gold does.
You own that?
Silver, I've traded, and I've lost money. I'm trading it the wrong way. I've traded the silver futures. I'll trade gold futures. I haven't done well with it.
But silver is industrial demand. That's half of why silver has gone higher. It's because of the industrial economy doing better.
Stephanie prefers copper and diamonds.
I do.
Yeah.
I do. That's very
Platinum.
true.
I was going to say platinum, too. All right, we'll take a break. All right, welcome back. So you may know Stephanie Link has been a big proponent of investing related to India. Now she has sold that position, but she's deployed it somewhere else outside the U.S., and that is Brazil.
Brazil.
The EWZ.
Yes.
Why so?
This is much cheaper than the INDA, but I still do like India for the long term, for the next decade. But I do think this year sets up really well for Brazil. They're growing GDP at 3.4%. Their fiscal and monetary policies are easing, which I think will propel the economy to grow even faster. And of course, it has a lot of focus on manufacturing, mining, agricultural. So that's really where I want to be. But the top 10 positions in the EWZ is really financials. There's two that are very big in this ETF, which I also want exposure to.
Can I get a 1 year of India, please? Because that's not really going to show you anything.
India didn't
right
do
there.
well last year.
Yeah.
It really didn't. It was flat. And I was very tempted to actually add to it because it didn't do much.
Basically sideways.
Yeah. But the prior year it was up 25%. So,
Right.
I mean, I still like it very much. If I had cash, I would have held on to it. So I'll look and see if there's other places that I can sell and maybe add back. But I do think Brazil outperforms India this year.
It feels relevant given this call we got from Deutsche Bank today, which says they're still bullish on the U.S. and Europe, but they closed their tactical Europe overweight. So, I mean, there is a lot of conversation, Josh, out there about U.S. versus other areas of the world, as other areas of the world outperform the U.S. by a large margin last year, and some wondering whether that's going to continue.
Yeah, and the most fascinating thing is that while many, I would argue most of the developed market country stock markets outperform the U.S. and many of the emerging, a lot of it was because of multiple expansion. In the United States, our large caps actually outgrew in terms of earnings what their share prices did. So in many cases, we had multiple contraction. I don't know when the last time you could say that happened was. And that gives me the ability to answer your question in the affirmative. Absolutely. If we see that multiple expansion, that re-rating that we saw for developed Europe, developed Asia, et cetera, if we see that justified by increases in God forbid, revenue growth and profitability for these companies, which is a huge focus overseas, absolutely, this could go on for 2 years, 3 years, 4 years. We've seen it before. I know people under the age of 30 haven't, but believe me, it is a thing, and it can persist for a very long time.
I see you're repping the U. You're putting your heart where your wallet is, quite obviously. You're on the bandwagon.
Forever. So I believe in diversified portfolios.
Yeah. All right. We'll come back with finals next. Just some final trades. Josh Brown, what do you got?
Reiterating, Exxon Mobil, great blue chip for 2026, in my opinion.
Thank you. Farmer Jim, gee, I wonder whose pick is Delta.
Could be Joe's, but I'll reiterate Delta.
Cleveland Cliffs was taken.
I don't pick stocks down 3%.
Are you looking at Cleveland Cliffs today?
Wynn was busy.
Are you looking at Cleveland Cliffs up 4%?
You talking to me? You looking at me?
Busy. Oh
The
my.
Linkster.
Capital One yesterday is such an overreaction. I'd buy it with two hands, two fists.
Okay. TKO.
Yep, held the 50-day, bouncing nicely, still in a bull trend.
All right, so we got some work to do in the market. We'll see if we can work our way back on the Dow, which is now down about a little more than 2/3 of 1%. S&P down by 1/3. I will see you on the closing bell at 3 on the exchange.
Hey, everybody. Welcome to Blue Cloud Trading. I'm George. It's Tuesday. It is January 13th. It's 2:34 p.m. Eastern Time. As I'm recording this video, we can see what's happening here in the markets. The Dow is down 0.72. NASDAQ is down 0.31%. S&P 500 is currently down 0.32. And Russell 2000 is actually slightly up, just 0.16%. What are we going to do in this video? We're going to cover the stocks and ETFs, not all of them, but a good portion of them that were covered on the halftime report. today, okay, from today's halftime report. Here are the indices. We'll look at those as well. The SPY, the Q, the Dow, the Russell, ETF, the Euro stocks, FEZ. We'll look at the VIX, which is actually spiking a little bit today, and about 17 stocks and ETFs. And what I've done is I've already reviewed all these stocks. I'm going to give you guys the strongest ones to consider based on the technicals, right? And what we're using here is something called the Ichimoku. We'll also look at the Mag 7, some of them, not all of them, like Tesla, Apple, Meta, Microsoft, and Amazon. Let me just give you guys a brief overview, okay? Brief overview of the indicator itself. So let's get rid of these lines for a moment, just so we can make this very simple and easy for you guys to understand how it works. For those of you who are new, there's always new people coming into the channel. So we've got a weekly candle. We have a weekly chart here, and we've got price, the Japanese candles. All right. Currently, the S&P 500, the SPY, is at $692.93. You can see the timer down here. It's currently 2:35 p.m., and the seconds are counting. And so you will see the percentages change here as time progresses, since we're doing this live, right? Well, at least I'm doing it live. You'll be getting this a little later. But here's a weekly chart. What we've got is the 9 period. So what is that? It's the midpoint of the last 9 periods. It's plotted right there. Then you've got the 26 period, okay? And that's the midpoint of the last 26 periods plotted right under the candle. This one's called Tenkan-sen. It's a Japanese indicator, by the way, called Ichimoku indicator. This is called the Tenkan-sen. This is called the Kijun-sen. All right, then we've got the Chiku span. That's the white line that you see in the background. That's actually the current price right here, just projected 26 periods into the past as a line. And what we're looking for is that white line to be above the candle 26 periods ago. If it is, that's very bullish. We also want that green line, the faster moving average, to be above the slower one. That's important. And then you've got the actual Ichimoku cloud. 2 more lines, the Senko span A, that light colored blue line, and the Senko span B, the purple line, which actually creates the cloud itself. And how is that derived? Well, we take the midpoint of these 2 moving averages right here, and we project it out 26 periods into the future, and there it is. And then the Senko span B is derived by taking the midpoint of the last 52 candles, in this case 52 weeks, and then it's projected not under the candle, but actually 26 periods into the future. So we've got a future cloud to give us some insights. And what we're looking for is the Senko span A to be above the Senko span B. The thicker the cloud, the stronger the trend. Over here, you can see the cloud was very flat. That was not a good sign. And you can see some weakness in the past where the Chiku span was under price here. And you can see how price dropped. Yeah, so what we're looking for essentially is all of these elements to be on the right side. And currently, and we never want to add positions when price is under the cloud based on the rules of Ichimoku. This dotted yellow line is the 200-day moving average, and I also use the directional movement index that you see down below. What I'm looking for here is the green line right there, the positive DI9 to be above the negative DI9. It's going to be above. And I want to see the ADX moving up like it is right here. That tells us the ADX represents the momentum. The green line above the red line represents the direction, right? Directional movement. So if the green line is above the red, then we're moving to the upside. That's very bullish. Over here, you can see where price was under, right? Under. I'm sorry, the green line was under the red line right there. If you go straight up, you'll see how that led to a decline in price. So it can be very insightful. It can help us. And then when the ADX, for example, starts to lose steam, when the momentum starts to come out, as it did right there. Sorry about that noise in the background. I'm sitting outside, so I had to pause for a moment. Anyway, yeah, what we're looking for is that ADX to continue moving up. If it starts to decline or starts to move sideways like it did over here, that means that the momentum to the downside starts to decline, and then the buyers start stepping in, as they did right there. And you can see the move up. Wow, it's pretty loud and noisy out here today. I'm sitting on a patio outside, and there's a little bit of background noise. So, sorry about that, guys. It's just the way it is, okay? Here's the QQQ ETF. Here it is in the weekly chart. Here's the daily. Everything still looks pretty good. Let's throw on some trend lines as well. These are the levels of resistance, like the 637.01 level right here that you see. and that has not been taken out yet. On the SPY, we have broken through some previous levels of resistance. Actually, that should be a little bit lower. That should be right about, oh, I see. I think I did move the trend line based on this high here. The high was 691.66. Let's fix that. There we go. Okay. So right now we're still staying above it. You can see we broke above it on Friday last week. That Japanese candle right there broke above that 691.66 level, which is that high, the high of that candle. And we're still staying above it. So that's a good sign, even though we did drop slightly today, down 0.32 so far. The Dow Jones still going sideways. Not much to see here. It's just dropped a little bit, down 0.78% today. But overall, I like the chart itself. We're still in a very strong uptrend, as you can see here. Based on the Ichimoku, here's the weekly chart, also looking good. Russell 2000 looking good too. Here's the weekly chart. It broke above that 258.20 level last week on the weekly. And here's the daily chart. So down up 0.03% right now. Still looking pretty strong for the Russell. FEZ, the Euro stocks, okay, down slightly, just 0.15%, but also in a very strong uptrend so far. I mean, it's very normal for price to pull back a little bit and then continue moving back up again. We are in a strong uptrend overall. That has not been broken here. But you're going to have days where you have slight pullbacks like you did back here and here. And then you can see the continuation, or here, and you can see the continuation, right? Now, what I am concerned about is the VIX, because it's up 7.08. Now, this is something you don't want to see moving up. That represents volatility. It represents fear in the markets and concern by traders. And the fact that we broke and closed above the 26 period here is actually concerning a little bit. And it's a pretty big jump, 7% in just one day. So, yeah, that's what's also leading to the prices in the index dropping, except for the Russell. All right, now let's get into the stocks and ETFs they talked about on the show. And I've highlighted the strongest ones at the top with a little blue flag. That means that they fit the criteria that we're looking for, which is price being above the moving averages, above the cloud, a bullish cloud on both the daily and the weekly chart. So these are stocks that I would consider, but there may be some other things that we have to also review, and that's the levels of resistance and technicals, the traditional technicals, basically. So here's MLM, Martin Marietta Materials. This is an old level here. Let's go ahead and throw that right there at the top of that high. We're looking at a daily chart there. The high there is 665.18. There we go. Let's throw that baby right there. Now, here's the interesting thing. That was the all-time highs, right? As you can see, the all-time highs occurred right there on that candle back on October 15th of 2025. We surpassed it on Friday, January 9th. You can see it closed above it, and then it immediately pulled back under. Sometimes that will happen. And, this was not a really conclusive breakout because look at it. It just edged up above that 65.18. It did make a higher high. So that's a good sign. But we are pulling back now. And we'll see if this thing can turn around soon. This wick here is today's action. So what that represents, if you see a long wick like this on a candle, that represents buying that's taking place towards the end of the day. And so the low of the wick is the low of the day. The high of the wick is the highest price of the day. And so let's look at the 5-minute. Here's the 5-minute chart. And so as I mentioned, here we are on the 13th. Okay, January 13th. We see the pullback that happened, and it's been getting bought up throughout the day here. So you can see that higher low here, right, on the 5-minute chart. And then we also broke out above that high. So that's a good sign. It's an ascending triangle that has been broken on the 5-minute. On the 5-minute chart, we are above the cloud. We're above the 200-day moving average. That's that dotted yellow line that you see right there. Currently under the Tenkan, and we're flirting with the initial opening price today, this morning. There's the dotted green line. So we'll see what happens with MLM. MU, Micron Technology. This is a 5-minute. It's currently dropping, down 2.11%. Here's the weekly chart. All right. That's not a very pretty candle there. It's also a little bit extended at these levels. And then here's the daily chart. Now on the daily chart, it just looks like it's basically building a base here. All right. Price is really in a nice tight consolidation. And until we'll see, if things get more bullish, maybe tomorrow, because it doesn't look like it's going to happen today. So we're already at 2:45 p.m. and I don't see any major moves unless there's some really positive news that pop out today. So for the time being, I would not be adding a position here. I'd be waiting to see what happens tomorrow, the next day. So there we have that. But overall, I like it. That's why it's got a blue flag on the in this watch list here. OIH is another one they talked about. That's Van Eck Vectors Oil Service ETF, which is actually up 2.36% today. So this is the daily chart. I do like this chart overall. It looks very, very bullish. We've got a series of higher highs and higher lows, right? So you can see the trend there. And we've got basically a upward channel. All right, so a bullish channel. And I like it. That's the daily. There's the weekly, above the cloud, above the moving averages. SMH, semiconductor ETF, looks good. Okay, so it broke through this level, the 372.78 level. That happened on Friday last week, January 9th. We closed above that level, and here we are above it still. There's the daily chart, only up 0.38% today. So still looks good. TKO giving us a buy signal here. Why is that? Because it was declining. It's pulled back. And now look at this nice bullish candle. It's up 4.02%, breaking above the Tenkan-sen. Now, currently, it seems to be dropping a little bit. Do you see that little wick that I see right there? That's what that tells me. If I switch it to a 5-minute, we can see that. Or at least it's just pulled back slightly, like about 0.4% since 2:10 p.m. So that's and we're stuck in this little consolidation area. So, would I be jumping into this one? Probably not, based on this candle. It's too close to the Tenkan-sen. And the fact that we don't have a lot of volume here doesn't really make me very optimistic that this thing is going to definitely move up tomorrow. Here's the weekly chart. It does look pretty good on the weekly. You can see that we're forming what's called a bullish engulfing pattern. That's the pattern right there. 2 candlesticks, the little red candle and the bullish candle that engulfs it. All right, let's go to the next thing. XLK, which is still on the weekly chart stuck in this symmetrical triangle. Here's a daily chart as well. Isn't that interesting that it's been stuck in coiling up, coiling up? We're going to see an explosion soon. I'm not sure exactly, which way it's going to go, honestly. It's more likely because right now you can see the red line is above the green line. Okay. But it is dropping. The green line is moving down as well. We're not getting a clear direction with the directional movement index. The ADX is dropping too. So it's not, what that tells us is there's no clear direction here for XLK, for technology, for this ETF. And so as long as we stay inside the symmetrical triangle, I'd probably hold off on buying this, obviously, even though technically speaking, if you look at the cloud, the Senkou span A is above the Senkou span B, but look at it. It's flat. It's not moving up. It's not a thick cloud like it was back here. There's a little bit of concern happening. And so you can see also like how the cloud reacts to price when it starts to coil up like this. It becomes flat. Okay. And unfortunately, when the cloud itself is flat like this, it's much and very thin. It's much easier for price to break above it and below it, and just it doesn't act as a strong level of support generally, like it did over here. So over here where the cloud was thinner, you can see how it broke through and then recovered. All right, so we'll see what happens with XLK, XOM, ExxonMobil. Okay, stalling at that. Well, wait a second. Hold on, folks. Hold on. We're looking at, okay, let's switch it to a weekly chart. We got to go back to this level, the high of October 11th of 2024. That's the last time that we were at 126.34. You can see this pattern that's been forming here. Now, what's going to happen here? I don't know, but it does seem to be breaking through it now, just up 5 pennies above that level. That's a weekly candle that we're looking at. I'd want to wait until Friday to see where this ends up, honestly. Here's a daily chart. stalling. You can see the spinning top. That's not a fairly bullish candle, up 1.92%. We switch it to a 4-hour time frame. You can see how it keeps stalling there. 2-hour, right? It did break out above it on the 2-hour, and now it's just kind of holding up above it. What about the 30-minute? Yeah, it's just a lot of consolidation happening right now. And if we look at the 5-minute chart, it's also telling us the same thing, that we really shouldn't be doing anything here. See how it's kind of stuck in this little consolidation area? So I'd hold off on Exxon for the time being. Adobe is down another 5.56%. A stock that is not in favor currently. You can see on the weekly chart, it's been in this declining downward channel for like a long time now, right? We've got a downward channel that continues to drop. So it's not looking pretty on the weekly chart. And here's the daily chart as well. In fact, today it looks like, yeah, it looks like it's more than likely to close under this low, which is makes it look even weaker. You see that right there? And look at that ADX moving up. The negative DI is above the positive DI. The volume is increasing. That's not a good sign for Adobe. Notice how the price came up to the 200-day right there and got rejected and pulled back right under that cloud. The future cloud is also showing some bearishness. See how the Senko Span A crossed under the Senko Span B. The Chiku Span is under price. These are all clues that you should not be adding a position here. It's as simple as that. Are the fundamentals good for Adobe? Well, the profit margins are 30%. You know, the operating cash flow is good. Sales growth rate, it looks good. The price of sales, it's like 6.5. It's not that great, but right now is not the time to be jumping in because there's no interest here, and so you want to wait for clarity. And usually, you want to wait for the weekly charts to start showing you some strength first. And right now, we're nowhere close to that. That's why it does not get a blue flag. Notice how the rest of the stocks that I just mentioned were looking very bullish. This one, not so much. Capital One Financial dropped this week. Here's a daily chart. Okay. We talked about that yesterday as well. Down another 0.25%. Seems to be stalling at this area of 232.45. So we'll see if it can hold up above that level. All right. Here's a weekly. It's based on that shooting star candle. So we are holding up above it, and we are above the Tenkan and Kijinsen. We'll see if we'll get a bounce here. But remember, the financials are getting clobbered right now. What else? CRH, basic materials sector, building materials. It's just kind of like consolidating on the weekly. On the daily chart, it dropped a little bit here down under the Tenkan. All right. I would not be adding positions here, obviously. CVX. Chevron looks okay on the daily chart, but in the cloud itself, I mean, it's very thin here, but it is showing some strength, but it also reached a high and then it looks like it's dropping now. You can see that little wick that's developing. Let's look at the 5-minute chart. See how it's like pulling back a little bit from these highs of 166.15. It's dropped 0.81%. Currently, we are at 2:53 p.m. Eastern time. DAL on the weekly. Let's start with the weekly chart on Delta Airlines. It's Farmer Jim's, right? He likes that one a lot. Down 2.76%. It is kind of consolidating right now on the weekly here, stuck inside this little box. Nothing really to do here. It's holding up above the highs from, let's see, around this area here, somewhere around January of 2025 on the weekly. Wait a second. Yeah, January 2025. So it's holding up above these levels. We'll see what happens here on that one. Here's the daily chart. It actually dropped under the cloud. I'm sorry, under the Tenkan, under the Kijinsen. It seems to be holding above this low. See that low of 68.50. It's at 69.04. Let's look at the 5-minute on that one. This is what the 5-minute looks like. It's not looking that great. So I'd hold off on Delta. Obviously, it's when you don't have all the elements of Ichimoku confirming, it's not usually a good idea to jump in. EWZ, Brazil. How does this one look? Right now, it's currently inside the cloud. The Tenkan is under the Kijinsen. The Chiku Span is under price. And the cloud is turning bearish. So you tell me, what do you think? You think you should be jumping into this one? You can see here, we're under this trend line right here. It looks like it's also kind of, let's see, did it break that? Yeah, it might have broken that trend line right there, but it's holding up above the Tenkinson. So not a ETF I would be jumping into. Here's IGV, the software index fund ETF under the cloud. Another one I'd stay out of. Okay, there's the daily, there's the weekly chart, bearish right there. INDA, India. Should you be jumping into this one? The answer is no, not right here, because it's under the cloud currently on the weekly chart, and it's under the cloud on the daily, and it's under the 200. And we are, you can see the decline here of lower highs, right? So it's pretty clear that you should not be jumping in. What about MasterCard? Another one that's down 3.55%. So this is an interesting one because you can see that long wick that's developing. It seems like there's something must have happened here where there's a lot of buying happening towards the end of the day. Let's look at the weekly chart. Here's the weekly. Okay. So it found a support level, the cloud itself, right? And then the buyers came in and pushed it right back above the cloud, which is interesting. Like I said before, the cloud acts as a level of support many times. It's used. This is an indicator that is used by a lot of financial institutions. It's been around since, published since the late 1960s. Used in Japan initially, and then it was brought to the West in the 80s. And a lot of, banks use it. A lot of traders use it. I use it. I like it. It's comprehensive. It tells us exactly what's happening in the markets at a glance, which is what Ichimoku stands for. So what's happening right now? Why is MasterCard getting bought up here? Well, let's do a little more investigating here. Let's switch it to a 5-minute. You can see that it pulled back today, right? It dropped. There's the opening price, that dotted green line. It dropped. Let's see. It dropped approximately 4.28% or so. And since this level here, it started to move up 2.24%. So it's getting bought up. So obviously I wouldn't be shorting this. It's down still 3.5%. And one of the things we can also do is take a look at, let's look at FinViz and type in MA. See if there's any positive news happening right now. Trump's credit card cap could hurt consumers. MasterCard stock tumbles. Plastic surgery, winners and losers of the proposed 10% interest cap. Trump's credit card cap could make most of industry unprofitable. Visa, MasterCard slide. JP Morgan vows to fight Trump rate cap. Trump targets card swipe fees after interest rate threats. Anyway, it doesn't look like there's any positive things happening here to justify the price moving up, unless there's some behind closed doors negotiations taking place that we're not aware of, and insiders are buying it up a little bit. We'll see what happens if it can continue tomorrow, really. But here's where the charts can give us a little insight of what's happening. If you start seeing a bullish candle forming, which represents a long wick on the bottom, and that is a very, it's a bullish candle, even though it's still a red candle, it's a bullish candle. Usually there's a reason behind it, but I don't know. We'll see if that can be a sustained move up. SYF, there's a 5-minute. That doesn't look particularly great, and that's also in the credit services. Let's see, weekly chart, stalling at the Kijinsen. Daily chart, dropping since yesterday after that gap down 1.38%. All right, let's look at some of those Mag 7 stocks that I mentioned earlier, like the Tesla, for example. Tesla is in between the two moving averages. We had a negative crossover right here. You can see the green line crossing under the red line. The Chiku span got under the candle there, that white line that you see there. That's also bearish. And the cloud is becoming thinner and thinner. As you can see, the Chiku span is dropping. And so I wouldn't be jumping in here either. Here's a weekly chart. It is finding support at the Tenkinson. That's a good sign for the weekly, but the daily is still looking relatively weak. So we'll see what happens there. How about Apple? Apple is still under the cloud, so not something I'd be interested in jumping into either. Here's a weekly chart. What about Meta? Meta is inside the cloud. No on that one. There's a weekly chart, and there's the daily. Not looking pretty. Microsoft also looks like it got under a a purple line. Now, the purple lines represent monthly levels. So let's look at a monthly chart. There's the monthly. It's based on, it looks like this high right here, 468.35. Yep, I'm correct. So it's based on that candle right there. And on the weekly chart, you can see we're getting under it. It was finding support on that monthly level on the weekly, multiple weeks. These are all weekly candles that you see right here. And then this week, it's dropping under. Now, it did drop under here and then finally close back above. So remember, we're early in the week. It's only Tuesday. So Microsoft could, by the end of Friday, still stay above that 468.35. If it doesn't, it could be a bad sign for Microsoft, especially if it enters the cloud itself. We don't want that. We do already have a negative crossover that took place with the moving averages. Okay, so yeah, Microsoft not looking that great these days. Amazon is currently above the cloud, but as I've mentioned before, the single span A is under still the single span B. The light colored blue line, part of the cloud, is under. That's bearish. Secondly, you can see here, yesterday we had a reversal candle right there, and look at what it led to, a down another 1.74%. So not great for Amazon. That's the daily chart, and here's the weekly chart. We also have a negative crossover here on the weekly with the moving averages. Okay, and guess what? That's going to do it for this video, folks. I hope you enjoyed it. I hope you learned a few things. If you want to support this channel, let me tell you a couple of things you can do. If you want to see more of my stuff, what you do is you come to Blue Cloud Trading. And I do member-only videos like this one here that I did 3 days ago. I go over my entire portfolio. There's a lot of stocks in there. I also provide new stock ideas for every week. And so how do you get access to this? You can't just watch it. You do need to join. You have to click the join button on my YouTube channel. It's right next to the subscribe button. It's free to subscribe to the channel, and I recommend it because once you subscribe, you can also hit the notification bell, and then when my videos pop up, you'll find them in right here in your notifications, and you'll know that, hey, George's video is up. Okay, so that's why it makes sense to do that. It's free. Now, if you want to support the channel, go to the next segment here, the join. Click on that. It pops up this box. And there are 3 different membership levels. We've got Blue Cloud Supporter. Okay, there's the price there. And why does it make sense to do this? Well, you like my channel. You want me to continue making videos. And you want to show your appreciation, become a Blue Cloud Supporter. I will, if you want to, I will basically, if you request one stock or ETF in the comments section segment, basically I will do an analysis of that in an upcoming video. All right. Here's the next level, Blue Cloud Trader. Under this level, you get more perks. So under this one, you'll get access to those member-only videos like that one I just showed you a second ago. That's when you start getting access to those videos. You can request 2 stocks or ETFs per month, all right? And then there's one more level, and we got Blue Cloud Legend level. I've kept the prices at the same level as I had them last year for now. Blue Cloud Legend level membership. And what you get here is the following: access to those exclusive member-only videos. You can request up to 3 stocks or ETFs per month. You'll access some of my recorded day trading videos. But the most important thing, I think, is the daily stock and ETF trades update. This is where I actually share the trades that I place each day, and had some nice profitable trades actually today that I posted. And so how do you get access to see those? Once you become a member, once you become a Blue Cloud Legend level member, there'll be a new tab that pops up to the right here next to posts. It will look like this. It'll say membership. You click on that and you'll be able to see it. In fact, there's an older post. This is an example. There's a sample here under posts. So if you go here for free, you can see one of my posts from last week, I believe. So you can get a sense of what those look like, all right? And that's going to do it. Thanks for watching. By the way, one more thing I'll mention is if you like the software that I'm using, it's called TC2000. And there's a $25 coupon, and you can get access to that coupon. It's an affiliate link by clicking right here, which says 9 more links. Scroll down, and you'll find it right here. $25 coupon for TC2000. You click on this, it will bring you to the page, TC2000 page. This company's been around for like a long time. Award-winning analysis software for stock and option traders. To get access to it, you enter your email here. You download the Windows software. If you have a Mac, you click here, and as you can see here, you will receive, if you do that, you will receive a $25 coupon towards the TC2000 service, courtesy of Blue Cloud Trading, as long as you haven't used the service in the last 12 months. That's the key thing. And if you want to find out about their brokerage, because they do have brokerage services too, where you can actually trade off the charts, which is pretty cool. Or you want to look into the pricing, click on the software pricing right there. You can see the different prices, price levels. You can get discounts. So if you do monthly, these are the prices. So you can actually try the basic for free with that, with that coupon that I mentioned. If you become a premium member, it's $49.99 per month. Okay. And see, there it is. Thanks for visiting Blue Cloud Trading. Your $25 coupon will be applied at checkout. And so I would recommend the premium if you want to get all these other features that are included in premium. So look into those a little bit. All right. And then there's a premium plus as well, which is more expensive. And if you do annual, it brings the price down. If you pay for 2 years in advance, it brings down the prices even more. So maybe try it out on the monthly first, see if you like it, play around with it, and then you can decide if you want to continue with it. I strongly recommend it. If you are into trading, even if you have a mutual fund, just mutual funds, and you're just curious about trading a little bit. One important thing I should mention is that TC2000 also has mutual funds. Let me just show you what I mean. Now, there's a thing that you can't see. It's above here. It's called watch list. If you click on that and you scroll down, look, they even have Canadian common stocks, Canadian ETFs. You keep going down, you can find just exchange traded funds if that's what you're looking for. Fixed rate of return into Forex. If you want to trade Forex, you can do that. Keep going down here and you can see mutual funds, right? So if you click on that, and here's the list right there. Look how many mutual funds they have. Are you ready for this, guys? 32,734 items. Pretty wild. And if you click on this little move window here, we'll move it. Why don't we put it above here for a moment? And let's look at some of these. Let's scroll through for a moment. Why not? Here's one that looks pretty good. The Ichimoku applies on the weekly. Now, when you do it, mutual funds are kind of different. When you're looking at them on a daily chart, though, they only show them as a line form, that blue line that you see right there. So I would recommend just analyzing these on the weekly. Here's that one doesn't even have any information. There's another one. There's another one. You can see the different mutual funds that are in there. And you can search for them just by typing in something. Like, let's say I wanted AABA, and that's one of your things that you're looking for, AABA. Notice how it pops it up right there, right? Oops. There it is. Let me move this a little bit. There we go. It was missing some of the ticker symbols there. So that's TC2000 for you. It can be useful. Anyway, thanks, guys. I will catch you all in the next one.